So today I got a video for you guys coming from Italy in Rome actually. I'm filming it in the hotel room, so I've got to make sure I don't shout too loud because I know normally I end up shouting on my videos most of the time and I don't want to do it while we're in the hotel room. But I wanted to give you guys a bit of an update. The market's having a pretty good day today, but in my opinion there's actually some more bad news that came out in the last 24 hours that once again points to the consumer isn't doing that well, but I'll go through it all today. I'll talk about what's a little bit weak out there. I'll talk about Celsius as well. I think that's worth a little bit of a quick update, and also a stock that I'm actually quite interested in buying, and I probably will do a little bit of research on that stock in the next coming couple of days. But if we look at the market, the fear and greed index is getting a little bit stronger out there. Still not good, but it's getting a little bit better. The market, pretty good day. You can see the Dow is up 1%, S&P is up 1.6%, Nasdaq's up 2%, so pretty good day for that. And it's all rallying off the latest data that came out with the jobless claims. Jobless claims were okay, so the market's like, okay, maybe we're not so much heading into a recession yet. I don't know. I think that it's just trying to look for some good news at the moment. I think when you look at what is actually going on out there is the Q2 earnings. I thought the Q2 earnings have been very poor at the moment, and I think that just continues. Airbnb, you might have seen it Tuesday after it reported, the stock was down a fair bit. I think it's trying to do a little bit of recovery in here, but it's still down a fair amount. And it's just once again pointing to like a weak consumer environment out there. Airbnb's numbers, 10% year-over-year growth. The EPS did miss by a little, but they once again pointed to that their growth was slowing down. And this also lines up with what TripAdvisor said. TripAdvisor, they were down a fair bit as well. As you can see here, they're down at the moment around about 14% since their recent Q2 earnings, and they once again said there was a slowdown going on. I don't know exactly, I had it somewhere, but their revenue did slow down slightly. I've not got the number here, but yeah, a little bit weak from TripAdvisor as well. So once again, we're seeing, I think that's us, Airbnb, TripAdvisor, Ryanair, they've all kind of come out and said, travel's a bit slow this summer. Once again, points to the fact that if they're saying it's a little bit slow, the consumer's being a little bit more cautious about what they're spending, and will that then have the knock on to the economy. Now it might just be a little bit of a weak time for the travel space because we had that 2021, 2022, 2023 where everyone after COVID went out and everyone wanted to go on holiday. They were desperate, they'd been locked up, they wanted to go on a holiday. So there might be that natural slowdown going on, but I think it's also pointing once again to, is there a consumer slowdown going on? Now, even though Airbnb did go down a fair amount, I think you can call it a crash. One that still doesn't interest me. It's a good company. The balance sheet on that business is very good as well. But I think 27 forward times earnings. I think a few people still think like Airbnb is this, big growth stock at the moment. And I think 10% growth is, it's good. A lot of companies wish they could grow that sort of level, but it's not screaming out big growth to me. So I think something like that, in my opinion, when you're buying investments, when you're buying a stock in the stock market, you want to get a great business, which I think Airbnb is a great business. But you want to get it a great business at a good valuation or below market average valuation. And for me, 27 times forward earnings isn't a good company at a below market average valuation. It's not even a fair valuation. I think it's an expensive valuation. I think that you want to get that more towards 17 forward times earnings, 18 forward times earnings. So yeah, you can tell for me it's not something that I would be very interested in buying. And let's be honest, if there was a recession, this is easily going to fall to them sort of levels. It might not happen, but that's where I'd find it attractive. What once again pointed to me though is that do I need to be a little bit more cautious about this sort of space, any like big consumer stocks to be cautious about? And I was looking at Jet2, obviously own Jet2, up a good amount on Jet2, like 50-60% on the shares that I've had for a good 4 or 5 years. In fact, I've been averaging up on my position, so if I actually did hold my original position, I think I'd be even up like 114%, but I'd keep buying a few more shares in it. Even did it not too long ago, like a couple of weeks ago, bought some more shares. But the stock, to be fair to the stock, it hasn't really done anything, and year to date it's not really done too much. You could argue that it's priced in maybe a bit of negativity because it is down 13% since its all-time highs, but I was looking at this one thinking, do I need to really, move on from Jet2 just in case of that risk there? Because that's now TripAdvisor, Airbnb, Ryanair that have all come out with weak earnings. There's been a few more as well, but I can't remember them off the top of my head. But Jet2 numbers were good compared to a lot of these businesses. But saying that, this was when they brought the final results out, this was to March 2024, and we've seen the big slowdown in a lot of these stocks in Q2. So that would be between March and June time, so it doesn't really show the slowdown. But you look at Jet2's numbers and they were really good, growth 24%, profit before tax was up 37%. But what they did say in their update is that they said seat capacity is higher. But when you look at the booking side of it, they said that the booking at the moment is that people are booking much closer to departing for the holidays. And they talk about some numbers here, which was that package holiday customers are up 7%. And they said that the flight-only passengers were up 16%. They said the load factor is below 2023 levels though, and they said that people are leaving it a little bit later to book. Is that true? Are people leaving it a bit later to book, or is there currently a slowdown like we've seen with Ryanair, Airbnb, and is there a slowdown going on? And they didn't set any guidance out, which is probably a clever thing to do. But could we potentially see Jet2 come out in 2 or 3 months and say, oh, all those other businesses are slowing down? Yeah, we're slowing down as well. But saying that, Jet2 is like the best of the best. Their financials are actually, really good financials. They've been a lot better than the other companies. So even if Jet2 were to have a slowdown, they'd still probably perform a lot better than the other businesses. So that's the other thing is, do I want to sell a quality business, or do I protect myself because the financials could potentially slow down? That's something I'm kind of thinking about there when I've seen a lot of this weakness here. But yeah, once again, it's kind of just pointing to a lot of weakness out there in the consumer environment, which isn't good. And that was some bad news that once again, Q2 earnings, it's not been a good Q2 earnings for them. Really quickly, we'll talk about Celsius. Celsius, it's been a terrible month for this one, down 28% in the last month. Year to date, it's actually down year to date, down 32%. Yeah, it's been a tough time for them. However, it's now at 39 times earnings, which I think is probably the lowest I've ever seen Celsius at. I'm sure most of you guys have seen me talk about it on the YouTube channel before. If you're new here, they're an energy business, energy drink business that's taken big market share off the likes of Red Bull, Monster. And they came out with their earnings this week. Earnings were good. EPS was a good beat. Revenue was a good beat. 23% year-over-year growth. There's been a lot of questions about where this is going to come in because, as we know, they have switched. They've got partnership now with Pepsi. Pepsi doing all the distribution. And what happened is when they took over, Celsius basically said, we don't want any impact from the switch over to you sending out our products. So they got a load of stock, loaded it up. The growth went very high because of that. And then eventually Pepsi went, okay, we kind of know how much we need to get in now to manage the demand. And there's been that kind of balancing out of the inventory. And that's affected the sales where it looks very high, drops very low, and now it's kind of like leveling out a little bit now, which is good to see. And by the way, the gross margins have been very good and improving in a very good way, which shows once again strong demand and scale of economy starting to really pick up in this business. But yeah, overall numbers are good. I think people may expect them to grow like 50+% forever. If they grow 20+% for the next 5 years, it'll do very well. And also, international growth, 30% growth as well. And what also is very good for Celsius, and I don't know why the stock isn't rallying up today, is Monster came out with their earnings last night and the stock's down 11%. Now Monster missed EPS big time, they missed revenue big time, and the growth was only 2% revenue growth. And basically Celsius became the number 1 player on Amazon, I think now, overtaking Red Bull and Monster. They're getting eaten up by Celsius, and this was really good. And the fact that Monster reported these weak earnings and Celsius reported these strong earnings, and they're taking that much market share, and Celsius isn't getting a recovery off that is not fair to Celsius. After these earnings came out from Celsius, I think the stock should have been up, and this is actually getting a lot higher on my buy list. Well, I'll let you know I am actively buying it, but I'm thinking about buying even more now. And the fact that you can get Celsius, which is growing now 20+%, and it's at the moment 39 times earnings, and Monster is growing at 2% and it is 28 times earnings. So yeah, for 10 times more earnings, you're getting nearly 10x the growth, which there's a disconnect there. Either Monster's very overvalued or Celsius is very undervalued. There's definitely a disconnect there. And yeah, I think that the story for Celsius now is very good, and that they should be bottom here and it should go on to do very well in my opinion. So yeah, seeing the Monster's numbers so weak and the Celsius numbers so strong, I think it was a very good point for Celsius there. And last one's Ulta Beauty. So really quickly I never mentioned this, I think I might have mentioned it once, maybe many years ago or months ago. It's been a long time since I mentioned it. This is an interesting one. This is a stock that I actually thought I'd show you guys, that I'm actually considering that I really need to have a look at this as a stock to be looking at. It came to my attention because a lot of the guys on the Discord, the Patreon, which is so good because that's where a lot of my stocks come from now. Because instead of just me looking for stocks to buy, it's like having 500 different eyes looking at stocks and seeing opportunities out there. And quite often I'll have some stocks that come to me and I'm like, I'm not sure on that one, but quite often now a lot of the newer stocks that I'm buying are spotted by someone on there and they go, how about this one, Jacob? And I'll have a look and I'll go, oh yeah, that's actually quite interesting. And on the Discord, I think there's been 3 or 4 of you guys on there that have been pointing out like, I'm buying this one because it looks attractive. And then when I actually had a look the other day, I was like, okay, this actually looks really good. And that's where like Lululemon came from a couple of weeks back. And there's actually another new stock that I bought that's I've not even talked about yet on the YouTube channel that came from the Discord as well. And this one is, once again, it came to me on the Discord and I think, you know what, I need to have a look at this. So I've not been buying it, but I'm going to take a big look at it, and hopefully for you guys on the Patreon and Discord, we'll actually try to see if we can get a stock request on this one because I think it'll be worth it. That's where we have a look at a stock and see if it's a good opportunity there. And yeah, it's looking very interesting because year to date down 32%. The highs were, I think, around about, it was highs around about $540 in March time this year. So you're only going like 3-4 months ago and the stock's fallen 40%. And that big fall on the share price there, you're going back to the levels that it was at really in 2021. So a fair big fall for them. A little bit of a weak time at the moment for Ulta Beauty. However, the EPS was a very good beat. Revenue a little bit slower though. But if this company here can grow like 5-6% a year, which is what they were going to do until they did do a guidance cut, which you can understand in this environment, which is still okay. When I think cheaper makeup will hold up, which Ulta Beauty do sell. Even if it does 2 to 3% growth, I think this year, it's not a bad valuation. And you look at the track record of the business. The business has a really good track record of delivering good profit, good revenue growth, as you can see here. From 2020. Business went from 705 million in profit up to 1.2 billion profit. 2015, 240 million in profit. The next 5 years went up to 699 million profit. They've got a really good track record. Profit they throw off is very good. 1 billion in profitability. You're going to have options there. Share buybacks, which I think they already do share buybacks. Balance sheet wise, a lot different from the likes of Walgreens because the balance sheet is in a very healthy place. They're a lot better at the online sales as well. And the company is trading at 12 times earnings. I should have actually got this up before I did the video, but you look at it on a valuation point of view here, if it shows it up here, like this company is trading at 12 times earnings, and historically this company trades at like 20 times earnings. So even if we go to a year ago, 20 times earnings, you can see there, 20 times, 18 times, 19 times, 20 times. All the way up 2016 was actually 30 times earnings. So even if, let's say, the company now goes to a market average valuation of 20 times earnings, what it normally does, the only time it hasn't really done that is during 2023 and now. If it goes to 20 times earnings, there's already that's your metric expansion that could really help you there. But and then you add in the profitability. I think it even said on there like they're doing a share buyback. 1 billion of a share buyback, which is big because this company is valued at 15 billion. That's a very big share buyback that's on it. So doesn't need to grow at crazy rates at these levels, like 4 or 5% a year, and it's already nearly doing that in a weak environment. It's got the track record, good balance sheet, big share buyback, very historic low valuation. I think this is one that I need to have a good look at, I think, at some point. So I thought I'd let you guys know, maybe go do some research on it. But I think that's one on the Discord as well that we need to do a stock request on. So I thought I'd let you know on that one. That's one that I'm interested in, but I've got a lot of research to do on that one. So we'll see what happens anyway. So that's the video today, guys. Just talk about, once again, week Q2 earnings. Celsius, I think, has gone way too low now, and a stock that looks very interesting to have a look at, and I will in the next couple of weeks anyway. Hope you enjoyed the video. If you could, hit the like button. See you in a bit.